So what we have is a 25 basis point cut on the repo rate. We also have a quarter percentage point cut on the CRR, something that the market was not expecting, or at least only a minority was expecting, which essentially returns something like 18,000 crores to the system. So that's the action on the rate front. In terms of some of the other indicators, the RBI has lowered the GDP growth outlook for the current financial year from an earlier number of 5.8%, which it put out in October. It's lowered that now to 5.5%. On the credit growth front, it has stuck to the earlier guidance of 16% growth, so that stays. And on WPI inflation, the WPI inflation number for March 2013 has been cut from 7.5% to 6.8%. So this is again in line largely with what the market was expecting.
The marginal standing facility MSF rate, determined with a spread of 100 basis points above the repo rate, and also the bank rate, stand adjusted to 8.75%. These changes have since come into effect immediately after the announcement. We've also decided to reduce the cash reserve ratio CRR of scheduled banks by 25 basis points from 4.25% to 4% of their net demand and time liabilities NDTL, effective the fortnight beginning February 9, 2013. This reduction in the CRR will inject primary liquidity of around 180 billion rupees into the banking system. Today's decision to ease the monetary policy stance was informed by three considerations. First, both headline wholesale price inflation and its co-component non-food manufactured products inflation have softened through the third quarter. Several indicators such as the weaker pricing power of corporates, excess capacity in some sectors, the possibility of international commodity prices stabilizing, as well as inflation momentum measures suggest that inflationary pressures have peaked. However, further moderation in inflation going into the next fiscal year is likely to be muted, as the correction of underpricing of administered items is still incomplete, and food inflation remains elevated. Accordingly, the setting of monetary policy has to remain sensitive to these conflicting pressures and attendant risks. The second consideration that weighed with us was that growth has decelerated significantly below trend through the last fiscal year and through this year so far, and overall economic activity remains subdued. On the demand side, investment activity has been way below desired levels, and consumption too has started to decelerate. External demand has also weakened due to languid global growth. On the supply side, constraints in the availability of key raw materials and intermediates are becoming binding. While the series of policy measures announced by the government has boosted market sentiment, the investment outlook is still lackluster, especially in terms of demand for new projects. The third consideration that informed our decision is that liquidity conditions have remained tight. Although the Reserve Bank lowered the cash reserve ratio CRR successively in September and October last year and carried out open market operations, injecting systemic liquidity during December and January, the average net LAF borrowing at 910 billion rupees in January has been above the Reserve Bank's comfort level. This tightness could potentially hurt credit flow to productive sectors of the economy. The structural deficit in the system provided a strong case for injecting permanent primary liquidity. The policy document also spells out the three broad contours of our monetary policy stance. These are, first, to provide an appropriate interest rate environment to support growth as inflation risks moderate. Second, to contain inflation and anchor inflation expectations. And third, to continue to manage liquidity to ensure adequate flow of credit to the productive sectors of the economy. As has become standard practice by now, we've also given the following guidance for the period forward. With headline inflation likely to have peaked and non-food manufactured products inflation declining steadily over the last few months, there is an increasing likelihood that going into the next fiscal year, inflation will remain range-bound around the current levels. This provides space, albeit limited, for monetary policy to give greater emphasis to growth risks. This policy guidance will, however, be conditioned by the evolving growth-inflation dynamic and the management of risks from the twin deficits. We expect that today's policy actions and the guidance that we've given will result in the following three outcomes. First, investment will be encouraged, thereby supporting growth. Second, medium-term inflation expectations will remain anchored on the basis of a credible commitment to low and stable inflation. And finally, there will be an improvement in liquidity conditions to support credit flow.